welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, and I have Scott Carter on the line. He is CEO of Lear Capital. Scott, how you doing this morning?
I'm doing well. Thanks for having me, Joel.
Tell us a little bit about your firm, Lear Capital, and also a little bit of your background and how you ended up at Lear Capital.
Certainly, Lear Capital provides physical precious metals to affluent investors that are looking to diversify their portfolio. We've been around for 20 years, and we make a market every day where we're buying and selling precious metals for investment purposes from various investors around the country. We're located in California and do about 350 to 400 million in annual revenue. I got into this because I moved into the management ranks of Lear Capital to run the company, and it became apparent to me that precious metals are influenced, the price and the purposes for investing are influenced by so many factors: international factors, geopolitical factors, certainly economic factors, and currency factors, that I just became a student of what was happening in the market so that I could become informed and then communicate that to our clients and prospective clients on helping them make an informed decision.
Okay, so let's talk about some of the advantages of holding assets in precious metals.
Well, certainly right now, precious metals have historically been a great hedge against inflation. And it seems that every central bank around the world is trying to create inflation, from Mario Draghi to Janet Yellen here in the U.S., Japan with Abenomics. So as a hedge against the prospect of losing your buying power through inflation, gold and silver have played that role. Another advantage is that, especially with silver right now, there's an industrial demand. Silver is increasing from an industrial standpoint in just about every industry that we have, from microbionics to electronics to digital environments. So silver demand worldwide is growing dramatically, and that has been a great investment for the future on a supply and demand basis. And then I think the last thing is that you have an economy that has struggled, and when fear enters the market, Joel, gold and silver tend to perform well. And right now, even though the stock market has performed very well, there's this trepidation in the market that the bottom's going to fall out, that we're in somewhat of a bubble. And if that is the concern of investors, then they want to hedge their investments by having a portion of their portfolio in an asset that performs well in that environment, and gold and silver has certainly done that.
You made an interesting comment there, Scott. You said that every central bank, and including our Federal Reserve, is trying to create inflation. Now, I mean, back when I went to school, economics, and inflation really wasn't the greatest thing here. They're trying to create it. Isn't there a chance that if they do, get the desired inflation that they want, that it could just continue spiraling and get back to the situation that you had back in the 70s and early 80s?
Well, I believe that's the fear. They are fast. This currency experiment that they're doing, Joel, it hasn't been done before. The idea of creating trillions, literally trillions of dollars currency out of thin air has to create inflation at some point in time. And you're right, it can be controlled. I think that once the genie is out of the bottle, it's very hard to get it back in, as was proven in the early 80s when Volcker was the Federal Reserve Chairman. He had to raise interest rates to 18% to try to tame inflation and just put our economy in a severe recession. Well, to create that or to replicate that today, when you have $18 trillion of debt just in the U.S. alone, would put us not only into a deep recession, but will put us into a depression. So I think they're playing with fire here. That's why you see assets like precious metals stay in portfolios and perform relatively well, because there's a lot of fear that the Fed might be successful in creating inflation.
So we talked about some of the advantages of holding assets in precious metals. Can you touch on some of the disadvantages?
Well, certainly. Precious metals are a long-term trend. So you can have cycles in the market where precious metals don't perform well. In fact, even though for the last 10 or 15 years gold and silver perform well, the last 3 years haven't been a great time for gold and silver investors. You've seen a steady decline in the price. So I think for precious metals and other commodities, you have to have a strong stomach to be an investor in this environment, because you could have periods of time where the return on your asset is not that great. In an interest rate environment, which we're not in right now, Joel, but if you are in an interest rate environment, a disadvantage of holding assets like physical gold or physical silver are that it doesn't pay a dividend. So you're not getting a return on that asset if you're holding it like you would on a stock or a bond. But that's of little consequence today, because we essentially have negative interest rates. No one is making money on their dollars and CDs, and you're certainly not making money in any savings or any bond at this point in time.
And when you do investing, I know you structure a lot of different deals. I mean, are you looking at holding the actual gold, physical gold? Are you looking at gold futures contracts? What's your preferred mode of investing in these markets?
Our preferred method is to actually hold the physical gold and silver. We think that there's a disconnect right now between the price of gold and silver and the actual trends that should be driving the price of gold and silver. So essentially, you have the paper markets, the futures market, that are contracts are driving the price down. Right now, there are about 30 contracts being traded on an ounce of physical gold and silver. So that disconnect is significant in our view, and we think at some point in time they will correct, and you will see physical gold and silver, the price that's traded on a daily basis, properly reflect what's going on in the marketplace.
And let's just talk about the recent rally in gold. You had the Swiss referendum. First, I want to ask you, I mean, did you think that had any chance to pass?
No, I didn't think it had a chance to pass. I think that the governments are very powerful, and they can influence the message, and they can scare citizens into the concerns that expressed by the bank. There isn't a planet that wants to have the handcuffs or be constrained in what they can do with regard to printing money. And the Swiss, had they voted that in, would have put a constraint on the Swiss National Bank to not be able to print the Swiss franc in as much capacity as they have in the past. So I'm not surprised it didn't pass, because it would have restricted the government, and they don't want to do that.
Okay, so it didn't pass. You got a dip in the pre-market, and then you got just a vicious rally, and then now you're back up. You flirted with the $1,200 level, got up to $1,220. This is basis the front month contract in the gold futures. What are you looking at here? Are you looking for a couple sustained closes over 1,200? Have we seen the bottom? What's your outlook here for gold?
Right. I think the bottom is touched on times in an 1145 to 1150 range. We tend to bounce back off of that bottom, and it seems that just about every week there's a headline or there's an international address that is bullish for gold. And I think what we saw in the last 2 or 3 weeks, with gold moving around up to 1210, and now it's hovering around 1195.12, is that Europe is in a recession, and Mario Draghi is trying to figure out how he can print money, basically create a quantitative easing, buy bonds off these sovereign governments that are in bad shape, in a way to create liquidity in the marketplace. Well, that's just another way of devaluing the euro, printing money, and gold in terms of euro then will increase in price. And I think what you're seeing is the recognition that we're not out of this economic mess yet, and gold will perform well if the central banks continue to attack the problem by devaluing currencies.
Well, so when you talk about, the gold markets, the physical markets and commodity markets, you gotta talk about the miners. And boy, oh boy, these things have really been beat up. Is there some best in breed that you think it can survive this downturn in the market?
Well, I do, and you're absolutely right. They have had a tough go of it, and when the price is down at the point it is, Joel, it's very difficult to even find a value in mining the metal itself. But you have to look at some of the larger players that you're purely on their mining costs. Buried gold, they're huge, but their mining costs tend to be 20% below some of the other players. Barrick, Eldorado, Newcrest. These mining firms have a nice expense structure, and they can weather the storm of a $1,100, $1,200 price in gold for a longer period of time. You have other newer entrants into the market where they don't have the scale or the capacity, and you're seeing them with mining costs over $1,000 or $1,100, and it's just very tough to make a return for your investors when that's your price to get an ounce of gold out of the ground. So I think that the whole industry, the whole mining industry, is being painted with a low cost of gold or low price of gold compared to mining costs, and therefore it hasn't been an advantageous investment thus far.
Is there some that that have the higher cost of production? Do you think that they, may not survive or look to do some mergers? I mean, I know we had to talk about the Newmont AB American Barracks merger that kind of flamed out. Are there any ones that or think might be here, may need to merge to survive?
Well, I don't know the balance sheet, if you will, or the depth of capital on all these smaller new entrants into the market. But Medusa, Land Gold, Buenaventura, these newer entrants into the market, depending on where their capital structure is and their expense structure, certainly there's going to be some scale if they can be integrated into some of the larger firms. I don't know if that will happen or not, but as this price point in gold and silver remains at the level it is, it becomes harder and harder to generate a return, and investors will demand a return on the capital that they put in. So I'm sure the executives in those firms are trying to figure out a way to survive at these lower expenses, and if that means consolidation, then they'll find a way to do it.
And who did you mention had the some of the highest cost of production among the major miners?
Well, Newmont has a high cost production. Anglo Gold, Gold Fields, Gold Corp, although that's a very big firm with a lot of capital, but their mining costs are averaging, all-in mining costs are over $1,000 an ounce, and that's when gold's trading at $1,190 and you haven't really paid a return on your investors. It doesn't look like a very sexy investment at this point in time. So I think that the other miners that are in the 800s or the 900s, although it's not an incredible return, certainly you're not concerned about whether that company can generate a return in the short term for their investors.
And who are some of those companies with that lower cost of production?
Well, I mentioned Barrick Gold, Eldorado Gold, have a Newcrest Mining. Those three have mining costs, all-in mining costs in the mid-800s at $850. And that's about as low as you can get, which, in my view, Joe, puts a base at the price of gold. If it costs you $850 to mine, and before you generate a return, you're starting to see a baseline where gold could stay in this 1100 range given any demand at all.
Okay, and you touched on it briefly about the demand for silver. You said that was steady or increasing. What about the demand for gold? And also, if the demand for silver has been increasing, I mean, that's been really weak. I mean, I've been noticing this for quite some time, that the silver rallies have just been really muted in comparison to the gold rallies. When do you anticipate that turning around?
Well, I wish I had that crystal ball, Joel. I'll tell you, I just don't believe the price is reflecting of the activity in the markets for gold and silver, but especially for silver. Silver demand, as I said, is increasing very dramatically just from the industrial side. And then you have the investment component as well, and the increase in silver for investment demand is significantly higher than it has been in previous year over year. On the gold side, gold for industrial demand, primarily for jewelry, is actually slightly down. So that's down 4% this year. However, gold demand for investment purposes is up again for physical gold. So you have this balance, if you will, in gold where industrial demand is down, but investment demand is up. Silver, both are up, and yet the price is not reflecting it. So that's where I think that the paper markets, the COMEX markets, are out of step and the shorts are out of step and driving down the price. And eventually, the demand is going to overtake what we're seeing in the market, and you're going to see a price increase. That's why many investors see much more of a upside potential for silver. Historically, if you compare the price of silver to gold, it's historically traded 33 ounces of silver for every 1 ounce of gold. And we're currently at around 60 ounces of silver for every 1 ounce of gold in the market. So that's way out of pattern compared to historical pricing.
Okay, and just talk about just like the tipping point. I mean, we're trying to get back over 1,200 in gold. Fundamentals, everything that you can see in the market. What is going to make you like say, okay, we got a bottom in, we've turned the corner. We're heading back up to 1,300. I'm being a little exaggerated
Yep.
here, but what's going to be the tipping point for you in the precious metals markets?
Fear in the U.S. stock market will be the tipping point for the physical price. Right now, I think that investors are sort of whistling past the graveyard, as they say. They are appreciative of Dow at 18,000. They are banking their money in stocks, but they're very concerned about whether it's a bubble or not. And if we see a tweak at all of this bubble, the air doesn't go out of bubbles slowly, Joel. When a bubble pops, it pops, and it's very significant in the drop. If we see any signs at all, any fear at all, that the Fed has been wrong, and I think they have been with regard to the U.S. economy and certainly the world economy, we're seeing that that's wrong. You're going to see fear enter the market. You're going to see money taken out of the market, and that's when you're going to see the price of gold reflect the true price, because that money will be moved into safe haven assets like gold and silver.
Okay, Scott Carter. He's the CEO of Lear Capital, joining us here on Benzinga's pre-market prep, giving us a very detailed and informative look at the gold and silver market. Scott, thanks a lot for coming on, and we certainly like to get you on again for some further updates in the precious metals markets.
Joel, thanks for having me. Have a great day.
Okay, thank you.